All right, let's jump right into this explainer. Today, we're going to break down exactly how you can navigate the incredibly unpredictable 2026 market using large and mid-cap mutual funds. You know, if you've been searching for that elusive sweet spot in your equity portfolio, that perfect place where you don't have to choose between keeping your money safe and watching it actually grow, you are definitely in the right place. To make this super concrete, we're going to use the ICICI Prudential Large and Mid-Cap Fund as our real-world anchor, just to see exactly how these funds operate under the hood.
We've got a pretty tight roadmap for today. We'll start by defining that large and mid-cap sweet spot. Then we'll look at historical and recent market volatility. From there, we'll decode some crucial risk metrics, contrast the performance against peers and benchmarks, and finally wrap up with the key advantages for your long-term growth. Let's get to it.
So first up, finding that balance between stability and rapid growth. Let's tackle the core dilemma every single equity investor faces. Usually, you feel like you have to pick a side, right? It's either the sleep-at-night safety of massive blue-chip giants or the thrilling but totally aggressive growth of mid-sized companies. But what if you literally didn't have to choose?
Now, here is the absolute crucial point to understand. This category isn't just some clever marketing gimmick cooked up by a bank. It's a strict, SEBI-mandated framework. In India, SEBI actually dictates that a large and mid-cap fund must invest at least 35% of its assets in large-cap stocks. We're talking the top 100 established companies by market capitalization. Another 35% must go into mid-cap stocks, companies ranked 101 to 250. It's a structure purposely designed to force a balance between relative safety and high growth potential.
Think of it like this: that 35% minimum in large caps, that's your portfolio's heavy anchor. It provides stability when the market inevitably gets rough. And that 35% in mid-caps, those are your sails, catching the wind to drive serious growth. But the really interesting part is that remaining 30%. That's entirely flexible. The fund manager can dynamically deploy that final 30% into more large caps, mid-caps, or even small caps and debt, totally depending on market conditions.
And you can see exactly how our real-world anchor fund, the ICICI Prudential Large and Mid-Cap Fund, utilizes that flexible 30% right now in May 2026. Managed by seasoned experts like Ihab Delwai, the fund leans slightly heavier into the stability of large caps at about 40%, while holding mid-caps near 41%. But catch this, they've dedicated about 19% to small cap growth. They're actively using their flexibility to capture extra alpha, all while maintaining a highly diversified base.
Okay, moving on to history and recent market volatility. Because theory is great and all, but your money lives in reality. Let's see how this specific asset allocation actually survives real-world market chaos. Just look at the current landscape. We are riding some pretty intense waves of volatility right now. We've got a nuanced domestic economic recovery that kicked off in Q1, colliding head-on with global inflation pressures in April, and now anticipated regulatory changes stirring the pot in May. In this kind of deeply unpredictable environment, having that 40% large cap anchor is absolutely crucial to prevent your portfolio from capsizing.
But here is the ultimate proof of concept. Despite decades of turbulence, market crashes, and wild economic shifts, the ICICI Prudential Large and Mid-Cap Fund, which, by the way, happens to be the oldest scheme in this category, launched way back in 1988, has delivered a staggering 17.96% compound annual growth rate since inception. I mean, wow! That number is a true testament to the long-term resilience of a disciplined, top-down strategy that forces balance.
Let's transition into decoding some crucial risk metrics. I want to peel back the curtain and translate some of this financial jargon into what I like to call sleep quality metrics.
Now, if you're a conservative equity investor, you might be really tempted to chase the massive returns of a pure mid-cap fund. But contrasting a pure mid-cap approach with our blended approach makes the trade-off crystal clear. Pure mid-caps are highly vulnerable to market crashes and liquidity risks. The large and mid-cap blend, however, offers structural downside protection from those top 100 established businesses. It actively prevents those heart-stopping, checking your phone at 3 a.m. panic drops during a market correction. Let's break down the hard data to prove this, looking at a 3-year trailing period. The standard deviation, which measures absolute volatility, is just 14.39 for the ICICI fund, compared to a category average of 17.00. Then there's the beta, which measures how much the fund swings compared to the broader market. It's sitting at 0.93. That means it swings less than the market itself, while the average peer swings more. And the alpha? A massive 4.94 compared to the category's 1.36.
Instead of getting lost in the complex math, here's what this actually means for your daily life. A lower beta means you simply lose less money when the broader market drops. A high alpha means the fund manager is actively generating excess returns well above what the market naturally provides. And that lower standard deviation, that's your sleep quality right there. These numbers prove the fund acts as its shock absorber. It prioritizes capital protection while still keeping those sails full for long-term growth.
Section 4, Peer and Benchmark Performance Contrast. Let's see how this specific fund actually stacks up against the broader market and its direct competitors. Because let's be real, performance only matters when you view it in context. Over a 3-year period, the ICICI fund delivered 18.64%. Not only did it beat the category average of 15.87% by a very comfortable margin, but it also clearly outperformed its strict benchmark, the NIFTY Large Midcap 250 Total Return Index, which sat at 17.75%. And you know, when a fund consistently beats its benchmark, it proves the managers are making smart, active choices, rather than just lazily riding the market wave. Things get even clearer when we contrast the ICICI Direct Plan against major peers. Sure, you have funds like Bandon putting up an incredible 24.38% return, but that comes with significantly higher volatility. Then you have Quant sitting at 19.47%, but with a very aggressive style and a pretty steep 1.96% expense ratio. ICICI really hits a beautiful middle ground here. It maintains a highly competitive return near 19.7%, but does so with superior downside capital protection and a very reasonable expense ratio of just 0.65%. It's the cost-effective, steady hand at the wheel. Finally, let's look at the key advantages for long-term growth. As we bring all these data points together, we really need to clarify how you can use this for your own wealth creation over a 5 to 10-year investment horizon. So, you might be asking yourself, with literally thousands of equity mutual funds out there, why on earth should you choose this specific SEBI-mandated path for your hard-earned money today? Well, the answer lies in the massive structural advantages. First off, you get diversified exposure across market caps without the headache of managing separate large and mid-cap funds. Second, you get a balanced risk profile that prevents dangerous overconcentration in volatile sectors. Add to that proven capital protection when the market corrects, guided by seasoned managers like IHAB Del Y, who actively shift between sectors before they become popular. It is quite literally the best of both worlds. I want to leave you with this final, provocative thought to consider today. When you look closely at your own equity portfolio, do you truly have the right balance of anchor and sail? Do you have what it takes to survive the macroeconomic storms of 2026 and still capture the massive growth of tomorrow? Take a look under the hood of your investments, evaluate your own risk metrics, and decide if it's time to finally find your sweet spot. Thanks so much for joining me on this explainer, and keep learning.